Welcome back to Investing Talk podcast.
Today we're looking at Strive. The big question is it a good time to buy now?
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. And the first thing you really need to understand about Strive is that it's, well, almost in a category of its own when it comes to risk and, frankly, speculation.
Okay.
We're talking about a stock that's seen a 52-week price swing from a low of just 34 cents all the way up to $13.42.
Wow. 34 cents to over $13. That kind of range is, well, it's almost hard to believe. And we're sitting now, what, November 9th, around $1.51.
Exactly, $1.51.
See, with that volatility alone, it kind of suggests that your standard ways of looking at an asset manager, they just don't really apply here, do they?
No, they absolutely don't. And we can, put a number on that risk straight away. The stock has a beta of 17.4.
17.4.
Yeah. So for anyone listening, beta measures volatility against the S&P 500, right? The S&P has a beta of 1.
Right, standard benchmark.
So a beta of 17.4 basically means, mathematically, if the market moves 1%, Strive is expected to move 17.4%.
Goodness. That's not just volatile. It's, like you said, almost explosive, potentially in either direction.
Precisely. And that extreme risk profile, it really explains the recent history we've seen. I mean, look back at September 2025.
Yeah.
The stock dropped 15% almost immediately after news broke about that prospective Semler acquisition and also their initial big investment into Bitcoin.
Yeah, that Bitcoin move, that really spooked the market initially, didn't it? It seemed like a huge risk jump.
It absolutely did. The market read it instantly as a, dramatic increase in operational risk.
And those fears about risk, they quickly became panic about dilution, right?
Spot on. The dilution concern got really serious when Strive registered, I think it was 1.28 billion new shares.
1.28 billion.
Billion, yes. That news just hammered the stock. It caused nearly a 20% drop, one of the sharpest falls all year. Investors were basically saying, dilute the common stock, and we will punish you.
But then, almost right away, the whole story just flipped after that big slide.
Yeah.
In early October, didn't the stock suddenly surge like more than 27%?
It did. And why? Because management simply confirmed they were going to expand those Bitcoin holdings.
So what that tells me and tells you, the listener, is that this stock is now trading almost purely on, digital asset sentiment. Is that fair?
That's absolutely the key takeaway. They've made a really dramatic shift in strategy. They're not just positioning themselves as an asset manager anymore.
Okay, so how are they defining themselves?
They're now calling themselves a publicly traded asset management Bitcoin treasury company.
A Bitcoin treasury company. That term sounds important. For the listener, what does that practically mean compared to just being a regular asset manager? Does it mean 90% of its price movement now just tracks Bitcoin, regardless of how their actual AI asset management business is doing?
Functionally, pretty much, yes.
Yeah.
A treasury company, in this specific context, means they prioritize holding a significant chunk of Bitcoin right on their balance sheet. It's a model popularized by companies like MicroStrategy.
Right, I see.
So yeah, their valuation becomes fundamentally tied to the price of Bitcoin. Now, their asset management unit, it still exists, it still brings in revenue.
But the main driver now is Bitcoin.
The main driver for investor excitement and definitely for the volatility is now that Bitcoin exposure. It's a very bold strategic move to differentiate themselves, but it needs a lot of capital.
Okay, so the market punished them for trying to dilute the common stock earlier, but they desperately need cash for this big, visible Bitcoin strategy. How do they solve that problem? Which I guess brings us to the November preferred shares.
That's exactly the question. And the answer is those Series A perpetual preferred shares. The ticker is SATA.
Yeah.
It's basically a high-cost way to get cash, specifically designed to avoid hitting the common stockholders again while still bringing in a huge amount of money. On November 5th, Strive priced an upsized IPO for 2 million shares of SATA at $80 a share.
$80 a share. 2 million shares.
Yeah, that should bring in gross proceeds of about $160 million.
$160 million. For a company whose common stock is trading around $1.50, that's game-changing money. How are they planning to use that war chest?
They've laid it out pretty clearly in 4 main buckets. First, and this is the big one, Bitcoin acquisitions. really cementing that treasury strategy.
Okay, makes sense.
Second, they mentioned acquiring some income-generating assets, probably to try and smooth out returns a bit. Third is just general working capital. And fourth, paying down some debt.
But the real hook here, the thing that lets them raise so much without diluting the common stock, has to be the incentive for investors buying these preferreds, right? That 12% dividend sounds huge.
It is huge. And it completely changes the calculation for, say, institutional investors. These SATA shares, they're set to pay a massive 12% annualized dividend.
Annualized, okay.
And it's paid out monthly, starting December 15th, 2025. Now, look, it's a very expensive way for Strive to raise money, no doubt.
Yeah, 12% is steep.
But it does two things. It locks in committed capital, likely from investors who are prepared to be patient. And it gives those institutional investors a really high-yield instrument from a company that's otherwise super volatile and growth-focused. It's almost like a high-interest bond, but backed by this, Bitcoin strategy.
So we really need to watch November 10th then. That's when the SATA IPO settlement is supposed to happen.
Correct. November 10th. The cash should hit their books then.
Then the market's going to be watching like a hawk for what they do next, right? Especially those Bitcoin buys or any acquisition news. That date feels like a really big near-term catalyst.
Absolutely. How quickly they deploy that capital will be critical. If they announce a big Bitcoin purchase right after the settlement, well, that $1.51 common stock price could move very quickly.
Okay, let's pivot slightly. Let's step back from the big Bitcoin news and the preferred shares for a second and look at the actual, nuts and bolts of the operation. Because the fundamentals seem to show a real contrast, don't they? Especially liquidity versus actual profit.
That's really the core of the whole investment debate here. On the plus side, their liquidity looks surprisingly pretty strong right now.
Really?
Yeah. They have an exceptional quick ratio. It's 4.4, which basically means they can cover their short-term debts very easily. Working capital is about $2.16 million, and debt levels are described as modest and manageable.
Hold on. Excellent liquidity, modest debt. That sounds great. But didn't you also say they're losing something like $23 million a year? Isn't that like having a leaky boat with a really good bucket? How long can that liquidity actually last if the losses keep piling up?
That's a fantastic point, and it really underscores the risk. The strong quick ratio proves they're solvent today, but it absolutely does not solve the underlying profitability problem. The profit margins are still deeply negative. Net income on a trailing 12-month basis is, negative $23.54 million. That's the hole in the boat they have to fix.
And the returns just reinforce that story, right? Return on assets, return on equity, they're deeply negative too.
Oh yeah, very negative. Return on assets is minus 147.61%. Return on equity is minus 164.51%. They're burning through capital quickly.
So they are.
The whole bull case here relies entirely on the idea that these numbers will improve, and improve dramatically as they scale up. And as the AI-driven asset management part of the business starts generating more revenue faster, analysts are projecting that revenue acceleration, driven by partnerships and tech expansion.
Right, that AI asset management piece, that's supposed to be their competitive edge.
Yeah.
Besides the whole Bitcoin thing, they have some proprietary tech, they're growing market share. And you probably can't ignore the sort of moat created by the founder, Vivek Ramaswamy's public profile either. That name recognition has to give them an edge over quieter competitors.
It definitely does. They leverage that platform and visibility effectively to grow assets under management. But, and this is an important but, we have to note the lack of disclosed free cash flow figures.
Okay. No FCF numbers.
Not readily available, no.
Yeah.
And that silence usually adds a layer of caution for investors, because free cash flow is really the true test of how much cash a company is actually generating or burning after it pays for its investments.
Okay. So we have this clear conflict, potential high growth from AI and Bitcoin, funded by expensive preferred shares, but inside a company that's currently losing a lot of money. Let's look at catalysts. What could shift this balance soon?
Well, the first big signal is insider confidence. Vivek Ramaswamy himself bought $1.25 million worth of Strive stock on November 5th.
Okay, right before the big capital raise settled.
Exactly. That's him putting his own money on the line. It's generally seen as a pretty strong vote of confidence from the top.
Yeah, that's a significant bullish sign for the common stock, you'd think. Now, what about calendar dates? What should investors be marking down?
Okay, key dates coming up. November 14th, 2025. That's the projected Q4 earnings report. The market expects revenue to accelerate sequentially. If they beat expectations, it helps validate the non-Bitcoin part of the story.
Makes sense. Earnings are always key.
Then, December 15th. That's critical for those preferred shareholders. The first monthly dividend payment is due. If that payment goes through smoothly, it builds confidence in that 12% yield.
Got it. Dividend proof. And given the crazy volatility you mentioned earlier, that ETF rebalancing, when is that? December 23rd?
December 23rd, yeah.
Yeah.
End-of-year rebalancing for ETFs.
Yeah.
That could definitely cause big swings in the stock price, especially if Strive gets added to or dropped from any major index funds.
Right. Index flows can be powerful.
And then finally, looking a bit further out, January 17th, 2026. That's when the window closes for institutions to file their holdings. We'll get a clearer picture then if big money, hedge funds, mutual funds, have started moving into either the common stock or those attractive preferred shares.
Okay. So beyond those fixed dates, there's always market chatter, right? Especially with a high beta stock like this. What kind of rumors are floating around?
Well, the biggest one, and it's just a rumor right now, but if true, it would be explosive, is that Strive might allocate up to 50% of that new $160 million straight into Bitcoin.
50%. Wow, that's way more than they initially hinted at. That would be seriously doubling down.
It would absolutely be doubling down on the Treasury company strategy.
And are we hearing anything about big institutions potentially getting involved?
Yeah, there's definitely buzz. Speculation is pretty active that maybe a major ETF provider, or perhaps a well-known hedge fund, is getting ready to take a significant position, either in the common or maybe snapping up those preferreds once that first dividend payment hits in December.
Interesting. And lastly, there are always merger rumors with these kinds of companies.
Yep. The usual speculative talk, whispers about a potential reverse merger or maybe a big strategic partnership with a larger fintech company or a digital asset platform, something that could give them instant scale or help fix those revenue issues quickly.
Okay, let's try and wrap this all into an investment thesis. Technically speaking, at $1.51, Strive is still well below its key moving averages. That usually signals weakness, right?
It's technically weak, yeah. The price is quite a bit below the 50-day average, which is around $3, and the 200-day, which is about $3.12. That definitely shows recent momentum has been negative. It suggests it needs a serious catalyst to really turn the longer-term trend around.
Right.
But given that massive 17.4 beta, if a positive catalyst does hit, that technical weakness could flip into a very rapid recovery.
So considering that volatility and the current price, what's the sort of near-term trading range analysts are thinking about?
Well, if those catalysts materialize like a smooth capital deployment after Nov 10th and good earnings on November 14th, analysts see a potential bullish channel developing between, say, $1.30 on the low end and maybe up to $3 on the high end in the near term. The support around $1.30 seems fairly solid, but the upside, if the news is right, could be substantial.
Okay, let's just hammer home the risks one last time for everyone listening. Core risks are that ongoing negative profitability.
Yep, number one risk.
The potential need for more dilution down the road if this $160 million isn't enough or the burn rate stays high.
Always a possibility with growth stock.
And just the extreme market volatility shown by that, frankly, staggering beta of 17.4.
Absolutely. It is not a stock for conservative investors or those who can't stomach huge swings. However,
Go on.
the final investment outlook, weighing everything, still leans bullish. We'd give it an overall rating of, say, 8 out of 10.
Okay, an 8 out of 10. Why?
It really comes down to 4 main things. That strong short-term liquidity gives them breathing room. The near-term catalysts, especially the capital injection and earnings, are compelling. There's clear, rapid growth potential in their AI niche. And that Bitcoin treasury strategy, while risky, is undeniably unique and attention-grabbing.
So you're saying it could work for both short-term traders playing the news and maybe longer-term investors who want that aggressive, high-risk exposure to crypto and fintech innovation.
Exactly. It potentially fits both profiles depending on your risk tolerance.
It feels like that bold pivot into being a Bitcoin treasury company, plus raising all that cash with that huge 12% preferred dividend. It just fundamentally shifts the whole risk-reward picture here. It forces you as an investor to weigh massive potential innovation and yield against some pretty significant current operational losses.